Welcome back to FX Street. It is 2 p.m. Eastern, April 25th, 2012. Welcome back, one and all. Great you could join us. My name is Rosen. Very happy that you could be here today. We have a lot to talk about. We had the Federal Reserve that met just about 2 hours ago. They left interest rates unchanged in the U.S. at the 0 to 0.25% level. We now have, and this event used to be all at one time, but now they've broken it up into a number of parts. So at 12 o'clock Eastern, we had the interest rate decision. We had the statement that was released. We're going to go over the statement. At 2 o'clock, which is right now, 2 p.m. Eastern, we're having an economic discussion. Notes, I guess, from the Federal Reserve are being released as we speak. I'm going to read these headlines as they come across the tape, by the way. Fed officials reduced 2012 unemployment forecast to 7.8% from 8%. So there's a little bit more detail that we're going to get, and then we're going to have a press conference at 2:15 p.m. Eastern, where Chairman Bernanke is going to give us even more information. So we're going to try to keep up with these headlines and discuss what has happened today. So 7 Fed officials now see the first rate hike in 2014 up from 5. Fed sees U.S. GDP at the 2.4 to 2.9% level in 2012. Well, the range, it was at 2.7 to 3.1, or it is 2.7 to 3.1% in 2013, and 3.1 to 3.6% in 2014. We're going to try to put this in a little bit of a frame of reference. So what we're going to do is we're going to compare today's Federal Reserve statement to the previous Federal Reserve statement. And in addition, we're also going to take a look at the effects of the end of Operation Twist, which, for all intents and purposes, from the information that we have now, we believe it's going to be over. So let's get to the Fed statement first of all, and then we'll get to Operation Twist. It's all kind of together. Now, what we're going to do, I'll give you a link, by the way. This is the link from today's Federal Reserve statement. Okay? Here's the link today from today's statement. But what we're going to do is I have this nice little website that you post in two paragraphs, and it'll compare the differences between one paragraph to the other. It's kind of neat. So what we're doing is we're going to compare the Federal Reserve statement, today's statement, from the previous statement that was released in March. There are very subtle little differences in the language. Now, for the most part, the statement is the same. They're leaving rates unchanged to 0 to 0.25% level. That's unchanged. They see that the economy is expecting to grow only at a moderate pace. That's unchanged. But there are very subtle little differences in the language that completely determines where the market will go. So we're going to take a look at the subtle little differences. And again, we're comparing the statement from March and today's statement. March statement is obviously looking back from January of this year through March. Okay. So we read, and I don't know if you can, I hope you can see the screen, but the statement on the left-hand side is today's statement. On the right-hand side is the statement released this past March. Okay. We're just going to talk about the differences. Information received since the last meeting says the economy is expanding moderately. Labor market conditions have improved in recent months. Unemployment. Now today they said unemployment rate has declined but remains elevated. In March, reflecting the previous meeting, they said the unemployment rate has declined notably in recent months. Today they said remains elevated. Not much of a difference, but we're looking for any difference at all in the language. They continue, they said household spending and business fixed investment has continued to advance. Today they said despite some signs of improvement, the housing sector remains depressed. In March they said the housing sector remains depressed. So today they said, this is one, and I'm going to type them in, the housing sector has shown some signs of improvement. That's the first. Okay, they actually said despite the improvement, it still remains depressed. But today they did acknowledge the fact that the housing sector has some signs of improvement. They said inflation has picked up somewhat, mainly reflecting high prices of crude oil and gasoline. In March, they said inflation has been subdued in recent months, although prices of crude oil and gasoline have increased lately. Not much of a difference. However, longer-term inflation expectations have remained stable, and that's what they said last March as well, this past March. Okay. Second sentence, or second, I guess, part of this statement, they said today, consistent with the statutory mandate, the committee seeks to foster maximum employment, price stability. That's unchanged, of course. The committee expects economic growth to remain moderate over coming quarters and then to pick up gradually. Last March, they said the committee expects moderate economic growth over coming quarters and consequently anticipates the unemployment rate will decline gradually towards levels the committee expects judges to be consistent with this dual mandate. So in March, they said they anticipate unemployment will decline gradually. Today, they said the committee expects economic growth. Committee expects unemployment rates to decline gradually as well. So actually, not much of a difference. Strains in global financial markets continue to pose significant downside risks. That was today. It said strains in global financial markets have eased, though they continue to pose significant downside risks. Not much difference. They said the increase in oil and gasoline prices earlier this year is expected to affect inflation only temporarily. Today, they said the recent increase in, that was today. In March, they said the recent increase in oil and gasoline prices will push up inflation temporarily. Actually, not much of a difference. They still expect oil to be somewhat of a strain to the economy. They said to support a stronger economic recovery and to ensure help insurance that inflation over time is at a rate consistent with the mandates. They're going to keep rates exceptionally low at least through late 2014. That is unchanged. The committee also, let's go right to the differences here. That's about it, actually. There's not much of a difference, surprisingly, in the two statements. And I used, a web page that compares the two statements word for word. There really is not much of a difference. Let's go back to see if I missed anything at all. They said, committee expects economic growth to remain moderate over coming quarters and then pick up gradually. They said the committee expects moderate economic growth over coming quarters and anticipates unemployment will decline gradually. Strains in global financial markets continue to pose significant downside risks. I guess that is a difference. They said strains in global markets continue to pose significant downside risks. In March, they also acknowledged that, but they said, though, have eased. They took out have eased. The recent increase in oil and gasoline will push up inflation. So the statement is actually very, very close. You are correct, though. The projections have changed. Now, let's go back to the statement is so more or less unchanged. The projections have changed, which is exactly what FX Pips have said as well. Okay, so let's look at the differences. Okay. 14 of the 17 efficiency rates at or below 0.25%. I want to identify the differences in okay. Okay, starting at 2 p.m. Okay. Fed, I'm taking this directly from the Dow Jones News tape. Fed cuts growth forecast slightly for 2013, 2013 and 14. That's number one. Fed raises 2012 growth forecast sees lower jobless rate, higher inflation. In that's for 2012. Fed sees lower jobless rates and higher inflation. Now, this is a really fantastic thing the Fed's been doing lately, is they're giving us these projections. In the past, the Fed would not give us these projections. They'd have their interest rate decision at 2:15 p.m. Eastern. They'd say we're leaving rates unchanged as expected. Then they'd release a short statement like the one we just read. We'd look for any differences in the language, and that was it for another 6 weeks. But and they would use these very approximate type of language. They would say we see the economy to be subdued, a moderate amount of inflation, a good amount of growth, things like this. These projections give us specific numbers that we should look for. Number one. And the reason why it's really great is because now we can look for the next second big economic numbers. And there's three big economic numbers that we have to watch. Inflation, meaning consumer price index, producer price index, CPI, PPI. That's number one. Number two, employment, specifically non-farm payrolls, the unemployment rate. Mostly the unemployment rate. Number three, growth, GDP. So these are the numbers. Okay. Fed sees longer run inflation at 2.0%. That's number one. Okay. They said core inflation. And by the way, when we talk about core inflation and inflation, we're basically saying the CPI. Okay? 1.8% to 2% in 2012. Now, they also give you the projections for 2013, 2014, but usually I always try to focus on the most recent data, or the data that we expect to see yet. The regular inflation, which is the headline CPI, we see it for 2012, 1.9% to 2.0% in 2012. Okay? The difference between inflation and core inflation, by the way, is core inflation excludes, or the core CPI excludes food and energy that are considered more volatile components of inflation. So if you look at inflation overall, and this is something they're talking about on the news earlier today, that the inflationary numbers have been going up, but the Federal Reserve has been saying, well, that's because of oil, and that's because of gasoline, and that's because food prices are so strong. But there are other areas of the economy that also have been rising a lot, like rent prices. Housing prices to buy have not gone up that much, but rent prices have. Now, that's inflation and core inflation. Fed sees a longer run unemployment. They see it, I should say, 5.2 to 6%. That's a longer run. Unemployment rates, okay, in 2012, I mean, that's looking out quite a bit. They say 7.8% to 8.0%. Okay, so we know the first Friday of the month, which is not too far into the distant future, into the near-term future, we have unemployment and non-farm payroll numbers. The Fed says for the rest of 2012, our guess, the Fed, is that unemployment will be 7.8% to 8.0%. What happens if the next unemployment number comes out at 8.5%? That means the Fed was way too optimistic. Things are much worse than the Fed thought they were. And that means, I think, that the Fed is not as likely to raise interest rates. Now, I almost said that means the stocks are going to go down and the dollar is going to go down. That's not necessarily the case. We're going to talk about this. The question we have to ask is, if unemployment is worse than the Fed expects, what will the Fed do then? If the unemployment rate is better than expected, what will the Fed do then? So I'm not going to answer that question yet, but it's what I want to talk about next. Really quickly with these projections. So that's unemployment. In terms of GDP, In 2012, 2.4 to 2.9. Okay, so GDP in 2012, 2.4%, 2.9%. I love the Fed gives us these projections now, because now we get to hold their feet to the fire. Okay, and now there's seven Fed officials who, let's see how they put the wording here. First rate hike in 2014, it was 5 before. Okay, that's not as important, I don't think so. Okay. Okay, and there's other things. Oh, last thing that's really important. Fed funds futures, which is really most important. This is what the market expects as far as when the Federal Reserve is most likely to raise interest rates. Fed funds futures, see 74% chance of a hike, interest rate hike in 2014 versus 66% on Tuesday. Okay, so overall, the Fed funds futures, which is basically the futures market that's trying to guess the next step, sees a 74% chance that the Federal Reserve, Ben Bernanke, will raise interest rates between now and 2014. 74% chance. It was 66% chance before the meeting. By the way, Ben Bernanke is now at 2:15, just 2 minutes ago, is starting his press conference. So at 12 o'clock, we have the Federal Reserve interest rate decision. Was it 12 or 12:15? 12:30. 12:30, the Fed tells us what they're going to do. 2 o'clock, they release their projections. 2:15, Ben Bernanke starts his press conference. So expect the market, we might see a little bit of movement right now because Ben Bernanke speaking as well. But I think most of the news is out there. I'm going to keep the news tape on the screen, though, just in case. Now, what have we learned? We have learned that there's 3 numbers that we have to watch. CPI, unemployment, GDP. Consumer Price Index, that's the CPI. Federal Reserve says in 2014, we see inflation at 1.9% to 2%, in that range. Core inflation, which excludes food and energy, 1.8% to 2%. Now what I'm going to do is this. Here, I'm going to show everybody, this is FX Street's economic calendar. This is really cool. Okay, so I'm going to start today's date, and we're going to go, let's say, to the end of May. That should filter all the numbers. We're going to look at only the numbers in the U.S. So I'm going to take away Australia, China, the EU, Japan, Canada, and the rest of them. We're only looking at the U.S. numbers. We're only going to look at the really, really big numbers. That's take away Sweden as well. Okay, so we should just have the U.S. And I'm going to move the slider all the way to the right. So that'll isolate only the really, really big numbers. And now, whoops, I need to go out a little bit further. March, let's go to the end of June, filter. Okay. Now, we have today the interest rate decision. The next big number, remember, 3 numbers, CPI, unemployment, GDP. Federal Reserve is going to announce a GDP number on April 27th. Actually, 2 days from now. Okay? April 27th. Now, the Federal Reserve just told us today that in 2012, their estimates are that the GDP will be 2.4 to 2.9%. By the way, the FX Street expectation, annualized GDP, 2.6%, the previous figure of 3.0%. So FX Street calendar is expecting 2.6%. The Federal Reserve and Bernanke is expecting GDP to come out in a range of 2.4 to 2.9. What happens if on the 27th, on Thursday, the 27th is Friday, I guess, what happens on the 27th if GDP comes in much, much better than expectations. Let's say it comes out 3.5%, much better than expectations. That means the Federal Reserve underestimated the economy. The economy is stronger than they thought it was. That means the Federal Reserve is more likely to raise interest rates. The Fed funds futures before the meeting said that means all of us trading futures on the Fed funds on the federal funds rate. Before the meeting, there was a 66% chance that the Fed was going to raise rates between now and 2014. Now it's 74%. If GDP beats expectations, that means the Fed's more likely to raise interest rates sooner. Maybe it won't be 74%. Maybe it'll be 80% or 90%. What does that do to stocks? Well, this is the question. On the surface, we would think, hey, that means the economy is better than expected. That should be good for stocks, right? I would argue with that. What is the reason why stocks have been so strong over the past couple of years? Number one, 0% interest rates. And number two, a lot of stimulus. Quantitative easing one, quantitative easing two, Operation Twist. All of these different measures that the Treasury and the Federal Reserve gave us, meaning the U.S. economy, they just said, the U.S. economy is in really bad shape. Give it quantitative easing one. It's still in bad shape. Quantitative easing two. It still needs help. Operation Twist. If all of a sudden the GDP numbers on the 20th that will be reported on the 27th, if they come in much better than expectations, not only does it mean we're not going to get any more stimulus. Think of stimulus like sugar, or caffeine. We don't need the energy anymore because we have a lot of energy. That means no more stimulus. And what does that also mean? That means that higher interest rates are sooner in the future than we once had thought. Well, that means that all those companies, all those businesses that did so well because of low interest rates, everyone that wanted to buy a house got really, really low interest rates. The banks issued a lot of loans. Well, the banks, it's a little bit of a different story. But on the surface, all those auto dealers, I think Ford just reported some really good numbers, in part, I'm sure, because all these low interest rates have really incentivized a lot of people to go out there and buy a new Ford truck. Everyone who wants to go to a store and get very, very low credit, you don't make any payments for the next 2 years, and they get 0% interest rates, all that will change sooner than expected if the GDP comes out higher than expected. It means higher interest rates are sooner in our future, and we're not going to get any more stimulus. So I would actually guess that would be a negative for stocks. Now, over the long term, if the economy really recovers, Apple is going to sell a lot more iPhones, and Ford is going to sell a lot more trucks. And over the long term, we would expect those stocks to go up. But in the short term, maybe not the case. Now, what does that do to the foreign exchange market? What does that do to the dollar? The number one reason why currencies move is the expectation of higher, lower interest rates. If GDP comes out much, much better than expected, well, I would say that would be a catalyst for the dollar to go higher, because the dollar, and everybody's trading the dollar, is going to say, hey, this is great. This means that the Fed might raise rates soon, and therefore the dollar would go up. And also the dollar would go up because stimulus is actually bad for the dollar. Because if you think about quantitative easing one and quantitative easing two, the Federal Reserve printed all this extra money. They printed extra dollars. They literally put more dollars into circulation in the economy in order to buy those long-term treasuries that was part of quantitative easing one and two. That diluted the dollar. I always have to say, think of it like a stock split, where you get more stock, the company prints more stock, but you don't get any more. We're left with the same 100 shares we had yesterday, but there's more shares outstanding, and that actually dilutes the dollar. In a stock split, the company prints more stock, but you also get more stock, so you retain the same percentage ownership of that company. When the Federal Reserve prints more money, my ownership of the U.S. economy in terms of dollars goes down a little bit. That's why oil goes up. That's why commodities go up. So I would say that if GDP comes in much better than expected on the 27th, that would be bad for stocks and probably good for the dollar. And conversely, if GDP really misses the mark, let's say GDP comes in at 1.5%. And again, the range that we're expecting is 2.4 to 2.9. If it really misses the mark, I'd expect stocks to go up, and I'd expect the dollar to go down. Because now the stock market's going to say, this is great. Look how bad the economy is. We're going to get more stimulus, and we're going to get lower interest rates for a longer period of time. The Federal Reserve's never going to raise interest rates. This is great. And also, and this is the immediate market reactions I'm talking about. Long term, obviously, long term, I expect stocks to go up and the dollar to go up as GDP goes up over the long term. But we're not talking long term. We're talking immediate market reaction. And if GDP really misses, I'm expecting the dollar to go down. Because I, like many people, are going to expect another round of quantitative easing or Operation Twist or some kind of stimulus that would essentially dilute the dollar, especially if it's quantitative easing. Okay, so that's GDP, the economic calendar. The next number we have to pay attention to is non-farm payrolls. May 4th, unemployment rate, 8.2%. Federal Reserve, their expectation now is that the unemployment rate in 2012, what did we say here? Unemployment will be between 7.8% and 8%, 7.8 to 8. I believe the previous projection was a little bit higher, 8 to 8.2, somewhere around that. But now it's 7.8% to 8.0% range. Again, if unemployment, remember, unemployment, if the number goes up, that's bad because it's unemployment. Now, if the unemployment number goes up, same thing as the GDP. It means the economy is getting worse, and I would expect stocks to go up and the dollar to go down. And conversely, if unemployment rate drops, to 6.5%, and it shows us the economy is a lot stronger than we once thought, then I would expect stocks maybe would go down in the short term, and then the dollar would strengthen. And then we look forward, that's GDP, that's unemployment, and the last one would be CPI, Consumer Price Index, which I guess I have to filter out this, move this down to 3 level here. Consumer, we just had the CPI. Durable goods, new home sales. When is the CPI, Consumer Price Index? It's got to be soon. Consumption, let's filter it that way. I'm sure it's coming out soon. I mean, it was just released not too long ago, but the same thing. We're looking. I don't see it on this calendar, but I'm sure it'll be included. Might just not have been added quite yet. But nevertheless, we're looking for inflationary pressures to rise. If they rise more than expectations, then obviously that would be a catalyst for the dollar to go up and maybe for stocks to go down on the short term. Now, we have to talk about the two scenarios, meaning that if the numbers are much better than expected, this means no stimulus and a greater chance of higher interest rates. If the numbers are worse than expected, it means that we're not going to get higher interest rates for a longer period of time, 0 rates for a longer period of time, and a greater chance of stimulus. But what specifically do we mean by stimulus? Well, we had, and I'll give everyone a trivia question right now. You should see a chart, by the way. I hope you can. This is from agorafinancial.com, but I've seen this chart all over the place. I've used this chart in the past. Okay, so here's a trivia question for everybody. What's the major difference between quantitative easing and Operation Twist? I'll give everyone a second to think about that. What's the big difference between quantitative easing and Operation Twist? Both are stimulus measures. Now, they're different amounts. I don't mean the amounts. One is $400 billion, another is $600 billion. That's not the major difference in my mind. Both types of stimulus were created to incentivize consumers to consume, to get back out there, to buy big-ticket items like homes, automobiles, refrigerators, anything that we could use credit to go out there. We had quantitative easing 1, and QE1 is what we're talking about. That's where the Federal Reserve, and if nobody answers, I'll tell you right now. Okay, quantitative easing 1 is where the Federal Reserve printed enormous amounts of money. They printed extra cash. They put extra cash into the economy, and they use that cash. I think we have an answer. Increasing money supply versus bond interest rate adjustment, increasing short term, decreasing long. Exactly right. Well done. Quantitative easing is when the Federal Reserve prints more money and then takes that money and buys long-term bonds. Long-term bonds with, like, let's say a 30-year maturity, a 20-year maturity, 10-year maturity. And as they buy the bonds, the bond price goes up, more demand than supply, and the bond yield goes down. It's another way of keeping interest rates as low as possible. That's why the 30-year mortgage rates went down so much. You could buy a house in the U.S. and pay less than 4% on 30-year mortgage. That's because we have 0% interest rates in the Fed funds rate, but it's also because of quantitative easing 1 and quantitative easing 2. It was 2 separate rounds. Those were the intended consequences. It wasn't enough, though. And there were unintended consequences. The unintended consequences were that the diluted dollar was weakened. And when the dollar goes down, what goes up? Commodities like oil. That's why gasoline became so expensive, because it required, all those extra dollars in the economy are competing against my dollars, and therefore I need more dollars to buy the same barrel of oil and gallon of gasoline and shirt from J. Crew, which is made from commodities, and a loaf of bread, which is made from grain, etc. So that's why commodity prices go up under quantitative easing. I don't know if the Federal Reserve necessarily anticipated for them to go up that much, but they did. That's why barrel of oil went up to $150 a barrel, and that's why we're still seeing oil in excess of $100 a barrel. Not so much, I don't think, because of tension from the Middle East or because of one specific piece of regulation or fiscal policy, meaning taxes. All that does contribute. But I think the big reason why oil has gone up so much is quantitative easing. That's why oil has gone up a lot more if you have U.S. dollars and not so much if you have British pounds or euros. Now, there has been stimulus in quantitative easing measures in other countries as well, but not, I think, to the same degree as what we've seen in the U.S. And I think that's why I haven't done the math, but I'm curious if oil has gone up that much if you calculate the price in Australia's dollars. Be interesting to see. Now, the intended consequences, again, is that we're going to stimulate the economy. Well, this chart shows us quantitative easing 1. This is the S&P 500. Quantitative easing 1, this gray area, this shaded gray area, marks off the beginning of quantitative easing 1, not when they started buying the bonds, but when they announced it, because we know the market's a forward-looking mechanism, so he's trying to get to the next step. So as soon as they announce quantitative easing 1, this shaded area begins, S&P 500. This was late 2008, early 2009, and we know that the stock market hit its ultimate low in March of 2009. Okay? And quantitative easing 1 lasted all the way through the beginning of 2010. But look to see what happened. S&P 500, after quantitative easing 1 ended, meaning after they stopped printing dollars and they stopped buying bonds, all of a sudden you take your foot off the gas pedal, and this is why you listen to analysts talk about exactly that. The Federal Reserve has their foot on the gas pedal. It means that they're adding fuel to the economy in the form of quantitative easing. It's amazing how simple it is. The Federal Reserve takes her foot off the gas pedal, meaning quantitative easing 1 ends, S&P 500 goes down. Now, I'm sure there's other reasons, corporate earnings, things of that nature, but how ironic. Is it a coincidence, or is it not a coincidence that the S&P 500 all of a sudden has its biggest move to the downside during that period of time that quantitative easing 1 ends, just prior to the announcement of QE2? Now, again, the market's a forward-looking mechanism, so I'm sure there was a lot of traders and a lot of analysts out there that in the middle of this dead period, they say, hey, look, the economy is really starting to turn to the downside. The stocks are going down too. Things don't feel so good. Maybe we're going to get QE2. And I think that's why we hit a bottom before the actual announcements. QE2, when they announced it, it wasn't a big surprise to a lot of us. By the time they announced it, that was actually kind of expected. And I think that's why the market bottomed out. Okay? QE2, latter part of 2010, QE2 was announced. S&P 500 was below 1100 when rallied all the way up. QE2 ended June of last year, and look to see what happened. All of a sudden, a major spill to the downside. Now, if you remember, also this was June of 2011, right? What happened August of 2011? That's when the stock market really crumbled because the S&P Standard & Poor's downgraded the U.S. credit rating from AAA to AA+. Now, you could say that the stock market really cracked to the downside because of S&P downgrade, or you could say it's because we didn't have any quantitative easing to act as a buffer on the way down. I would say both. We didn't have any parachutes, and we had a good reason for the stock market to go down. Operation Twist started the latter part of 2011, and since then, Operation Twist, stock market, off to the races. But what are we looking for next? When will Operation Twist be over? So far, according to the statement today, no change, June of this year, meaning in 1 month. In about 1 month, I don't know exactly what the date is, but in about 1 month, Operation Twist is scheduled to end. It doesn't take much of a conspiracy theorist to say, well, when QE1 ended, the S&P 500 dropped to more than 1,000 points, and 1,000 points in the S&P is a lot. When QE2 ended, the S&P again dropped from 13-something down to 10,000, 1,000 or 1,100, a significant drop. You know, the biggest drops we've seen in the stock market over the past couple of years has been right at the end of stimulus. Quantitative easing 1, the Fed takes their foot off the gas. Quantitative easing 2, what will happen in June? Now, we're Forex traders. You know, we don't really care so much about the stock market as we do about foreign exchange. So ask ourselves the questions. What will happen to Forex? Well, we know there's a very simple trade. It's called risk on versus risk off. We take a higher yielding currency like the Aussie or the Kiwi. We pair it against a lower yielding currency like the dollar or the yen. And I don't want to necessarily use a dollar because it's a little bit more complicated, because if we get more stimulus, it could dilute the dollar, but it might dilute the dollar more if it's quantitative easing and not so much of Operation Twist. So I'm going to take an easy currency pair, Aussie yen. High interest rates versus low interest rates. When we're in when the stock market's in a good mood, we say risk on. Let's take some risk. Aussie yen tends to go up because we tend to buy those currencies with a higher yield, like the Aussie and the Kiwi. Or if you really want to buy some high yield and take a lot of risk, you buy the Brazilian real. I think the Argentinian peso has somewhere around 10% interest rates, if I'm not mistaken, especially now with the oil company prices over there. The Mexican peso as well has a really high yield, but you know, most of us trade 8 currencies. Aussie and the Kiwi have the highest yields. Yen has the lowest. So when stocks go up, when we have stimulus, Aussie yen goes up. Well, I marked off these lines at approximately the beginning and end of quantitative easing 2 and Operation Twist. Now, I didn't include quantitative easing 1 because that bottom, March of 2009, followed that huge crash in 2008. So, you know, a lot of us could say, listen, the market was going to bottom anyway. You know, that wasn't necessarily because, you know, of quantitative easing 1. Maybe it's a little coincidental in that case. That, you know, let's take that out of the equation. So we're just going to look at quantitative easing 2, but we're using the same dates. And I actually did a little bit of research here to find out approximately when the Operation Twist and quantitative easing 2 started and ended. Okay, so, and I reserve the right to be wrong, but I believe I'm right. We had quantitative easing 2 began, and this, again, approximately November 4th, 2010. Okay? RZN, at the time, green line, and shows us where that horizontal price level intersects with that closing price of that day. 81.95, so we'll say 8,200. 8,200. Okay, so QE2 ended, and when I say began, I mean it was announced. Okay, because the market is a forward-looking mechanism. QE2 ended June of 2011. Ended June 2011. RZN 85.92. We'll round to 8,600. I think you can see where we're going here, right? Now, obviously, there was a bunch of moves in this. What happened March of 2011? This huge move down that we actually ended up recovering from. I'll give you a hint. It happened in Japan. It was a tsunami. The tsunami earthquake, nuclear disaster. That was absolutely devastating. And that actually brought the RZN down to lows of 7,400. And then we subsequently went to highs of 8,800. So we actually had a 1,400 pip move. Although the levels that I marked off only represent 400 pips, there was actually much money to be made inside that move. Now, obviously, nobody would have been able to predict what would happen in Japan. What did happen in Japan, that was horrible. But if we, of course, we definitely would have been stopped out of any kind of long trade. But if we continue to approach the RZN with a long strategy, my point being is that when we have any kind of stimulus, I'm going to continue to go long the RZN. Now, it could be a long-term trade, or it could just be day trades. And as long as we're only trying to buy the RZN on our day trades, imagine how many more day trades would have made money buying as opposed to those day trades to sell short. The trend is your friend, and the trend was definitely to the upside, despite that big move into the downside because in March of last year because of the tsunami earthquake. Okay. Now, quantitative easing 2 ended June of 2011, and if during quantitative easing 2, RZN went up, well, what happens when the Federal Reserve takes their foot off the gas pedal? We saw RZN go down. In fact, Operation Twist was announced, I believe, approximately September 21st of last year. So Operation Twist announced September 21st, 2011, and RZN at the time, RZJPY, was approximately 7,700. Okay, so the first trade we had was to buy RZN around 8,200 and to take profits around 8,600 QE2. Second trade, sell short RZN at the end of QE2 at 8,600 and cover your shorts at 7,700, 900 pips lower when they announced Operation Twist. This is not, a very complicated trade. This was a worldwide announcement that, everybody was very much aware of. 900 pips to the downside. Trade number 3, Operation Twist. Let's do it this way. OT, that's Operation Twist. Announced September 2011, RZN. We're looking at 7,700. Now, where's RZN right now? 8,400. 8,400 and counting. So if I'm long the RZN, according to the strategy, I should still try to maintain my long positions. Now, of course, we're painting the market in very, very broad strokes. You take a look at a daily chart and you zoom in, we say, well, the Aussie yen, maybe we broke a trend line already. Actually, look at that. Trend line fits almost perfectly with what we're looking at right now in the Aussie yen. This trend line, recent swing lows, by the way, take us down to 82.49. I'm saying 82.50. That's it. If Aussie yen breaks below 82.50, I am definitely not buying this Aussie yen anymore at all. Because I expect Operation Twist to end June, another month. And I think in the next month, as long as we have no big surprise, we're going to see a break of this line. Why not? I mean, it happened before. Now, not compare contrast that, but mix that in with our economic numbers according to the Federal Reserve projections. They project GDP to be 2.2 to 2.9% this year. They expect the unemployment rate to be 7.8 to 8.0% this year. They expect inflation 1.9 to 2% and core inflation 1.8 to 2%. And remember, if the numbers show us that the economy is really significantly improving, it means we're definitely not getting more stimulus, and we're definitely going to be a little bit closer to raising interest rates. Now, I think that would be a positive for the dollar, but it might be a negative for the Aussie yen, because the Aussie yen is a risk-on, risk-off kind of currency pair. Stock market goes down, the Aussie yen goes down. Stock market goes up, the Aussie yen goes up. So if these numbers show us that the economy is improving, I'm actually thinking Aussie yen goes down, which is what I'm thinking now. If the numbers all of a sudden get really, really bad, then I'm thinking more stimulus, zero interest rates for a longer period of time, and then I'm thinking Aussie yen goes up, because then we're going to see a greater possibility of more stimulus and a greater possibility of zero interest rates for a longer period of time. We could also talk about the bond market. I don't know if I have the time to do so, but the 10-year bond yield tends to go up when we expect inflation, meaning higher stock prices, and the 10-year bond yield tends to go down with the expectation of deflation or lower stock prices. Remember, the big difference between stocks and bonds are stocks move in anticipation of higher, lower corporate earnings. Apple Computer yesterday, after the close, announced that they sold in the first quarter of this year 35 million iPhones, double than what they sold last year this time. Stock is up. The 10-year bond yield is up as a result of better than expected economic news. Now, actually, I take that because the durable good orders this morning were not so good. But over the long term, the 10-year bond yields, 10 years is usually maturity that we tend to focus in on. The bond yields tend to move in the same direction as the expectation of interest rates. So if the economic numbers get better, I expect bond yields to go up, and maybe I'd expect the stocks in the short term to actually go down. So we have the dollar, we have the bond yields, and we have stocks. All we should use is barometers to gauge the market's reaction to the big three economic numbers that are going to confirm or negate what the Federal Reserve just told us. CPI, GDP, unemployment. Watch those numbers, and then watch the market's reaction following those numbers, and very logically think to ourselves, was a number better or worse than the Federal Reserve's projections? And based on that, well, do we think that we're going to see more stimulus and low interest rates, or less stimulus or no stimulus and possibly higher rates? And I think that'll help us position ourselves for the next big move for long-term trade. But again, short-term traders out there, day traders, scalpers, if we can identify the probable direction of the next long-term trend, imagine being a day trader able to, this was hard during QE2 because of the Japanese tsunami disaster. But take that away, imagine being a day trader and having the confidence to say, QE2, I think Aussie yen has a good chance to really go up. and it did. And then as soon as QE2 ended, being a day trader and saying, you know what, now I'm only looking for shorts. And then the day trader out there says, Operation Twist, we're on, I'm going to look for longs. Doesn't mean we're going to, find those trades every single day. But I do definitely think that it gives us a much better chance of success over the long term. And that's our goal. That is, I think, the easiest way to really summarize what we read from the Federal Reserve statements and what that implies moving forward. We do know I'm out of time. If you want to contact me directly, please feel free to do so at any time, www.forexlaunch.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see their calendar because we have a lot more to talk about, including GDP numbers this week. Again, we thank you for joining us. We wish you a great day, all profitable trades. And we look forward to seeing you back soon.